way every day goes.
One brand, one vision, providing Malaysians with a wholesome family shopping experience. Mr. DIY is more than just a household name. From one store in 2005 at Jalan Tuanku Abdul Rahman, Kuala Lumpur, Mr. DIY has expanded exponentially across Malaysia, helping more Malaysians to shop at value for money prices. With more than 950 brick and mortar stores nationwide, Mr. DIY offers an average of 18,000 products at always low prices. From hardware, household and furnishings, electrical, stationery to sports equipment, inclusive of toys, car accessories, jewelry, cosmetics, food and beverages, and more. Always located at convenient locations, Mr. DIY is certainly a favorite one-stop home improvement retailer loved by Malaysians. In line with our vision, Mr. DIY's successful growth has allowed our customers across the country to shop conveniently as we maintain the variety and quality of the products that we offer. Shopping is now easier at mrdiy.com.my as our customers are able to shop with us online 24/7 with just one click. Today, with the implementation of a robotic system in our e-commerce warehouse, we can better serve our customers by offering them an exceptional omni-channel shopping experience. At Mr. DIY, we remain true to our mission of providing convenience and value to our customers by dialing up our retail offerings. Our new retail concept stores are here to support Malaysians from all walks of life. Mr. Toy provides a wide range of value for money, fun and learning toys that are always low prices, always fun. Mr. Dollar, a dollar concept store with a fixed price bracket that is always 2 ringgit or 5 ringgit, ensuring everyone gets the best value for each ringgit. And Mr. DIY Express, a small version of a retail concept store that provides everyday essential needs to the local communities across small towns at affordable prices. In ensuring the operational efficiency of the distribution process, Mr. DIY integrated a centralized distribution center. The integration certainly increased our capability to deliver products to our nationwide stores network with better control and inventory management. Mr. DIY's journey continues with sustainability, an essential day-to-day aspect of our business as we operate across every level. Our sustainability efforts were recognized as we were admitted to the globally renowned FTSE for Good Index 2021. To support the country and the rakyat, Mr. DIY organized numerous CSR initiatives as well as other community projects. We stand tall with our values and promise of always low prices. And we continuously offer the convenience of quality, affordably priced products, and accessibility to our beloved customers. Mr. DIY, a homegrown brand for Malaysians. Mr. DIY, always low prices.
Mr. DIY is Southeast Asia's preeminent home improvement retailer, making everyday living affordable for millions. The company operates on a vertically integrated model, controlling in-house design, direct sourcing, and its own logistics network. This allows it to uphold its core promise, always low prices, with 90% of its products priced below 10 ringgit, targeting mass-market consumers. With over 1,000 stores across Malaysia, Indonesia, Thailand, and the Philippines, Mr. DIY commands a dominant 28% market share in its home market. Financially, the company is a powerhouse. Its landmark 2020 IPO raised 1.5 billion ringgit, fueling aggressive growth. This is reflected in its robust revenue, which reached 3.34 billion in 2022. Looking ahead, Mr. DIY aims to expand its footprint to 1,800 stores by 2028. Its scalable business model and strong brand equity position it to perfectly capture Southeast Asia's growing demand for essential household goods. Mr. DIY is not just a retailer, it is a leader in value-driven essential consumption.
Let's talk about liquidity ratio.
It measures a firm's ability to pay off its short-term obligations without relying on external financing. There are three main types: the current ratio, the quick ratio, and the cash ratio. The higher these ratios, the stronger the firm's liquidity position. We will move on to the first ratio, the current ratio. It is calculated as current assets divided by current liabilities. The highest ratio was in 2019 at 3.41, which means that for every 1 ringgit of liability, Mr. DIY had 3 ringgit and 41 cents to cover it. However, it declined in 2020 to 1.7 and improved from 2021 to 2023. Next, we have the quick ratio. The formula is current assets minus inventory divided by current liabilities. We exclude inventory because this ratio focuses only on the most liquid assets a firm owns to quickly settle its short-term debts. So the highest ratio was in 2019 at 1.18. It declined in 2020 to 0.42. It then improved in 2021 but dropped again in 2022. Finally, it rose again in 2023. Last but not least, we have the cash ratio. The formula is cash and cash equivalents divided by current liabilities. This ratio considers only cash as the asset to settle short-term debts. So the highest ratio was in 2019 at 0.63, and however, it declined in 2020 to 0.17. It then improved from 2021 to 2023. We can conclude that liquidity was the strongest in 2019, whereas 2020 marked the lowest point due to the global pandemic, which affected many business activities, including Mr. DIY's operations.
Now, I will summarize the overall findings from the 4 activity ratios we have analyzed. First, inventory turnover was strongest in 2021, showing very efficient inventory management, but it declined sharply afterward. This suggests possible overstocking or slower sales that tie up cash in unused stocks. Second, accounts receivable turnover peaked in 2020, reflecting excellent credit control or more cash sales. However, it has steadily declined since then, meaning customers are now taking longer to pay, which could weaken cash inflows. Third, total assets turnover reached its highest point in 2020 but has dropped and remained stagnant since 2022. This indicates the company may not be using its assets effectively or that revenue growth has slowed. Finally, the average collection period was fastest in 2020 but has gradually increased in the following years. While the numbers are still relatively low, the upward trend signals declining efficiency in collecting payments. In conclusion, the company performed exceptionally well in 2020 and 2021, but efficiency has weakened since 2022. To improve, the company needs to monitor inventory more closely, strengthen credit and collection policies, and find ways to better utilize its asset while boosting sales growth.
Hi, my name is Salsabila Usna and my matrix number is 2024825506. So today I will present Mr. DIY's leverage ratio analysis for the period of 2019 and 2023. First, what are leverage ratios? Leverage ratios are financial tools that measure how much a company relies on debt to finance its operations and growth. They show the balance between what a company owns and what it owes. Higher leverage can boost growth when managed well, but too much of it increases financial risk and the possibility of default. Investors, lenders, and managers often use these ratios to assess the company's financial health and stability. In this report, we focused on our key leverage ratios, which are debt to assets, debt to equity, long-term debt to equity, and times interest earned, or which we call as TIE. The debt to assets ratio stayed relatively stable over the 5 years, meaning Mr. DIY financed its asset moderately with debt. The debt to equity ratio peaked in 2019 at almost 4.0, showing very high reliance on debt that year. After 2020, it dropped and stabilized, indicating an improved balance between debt and shareholders' equity. The long-term debt to equity ratio showed the same trend, high in 2019, then reduced afterward, reflecting lower long-term debt dependence. The TIE ratio, however, shows a risk. Mr. DIY's earnings are currently not enough to cover interest payments, meaning its debt is not being managed effectively. Overall, 2019 was the riskiest year, but from 2020 to 2023, Mr. DIY lowered its debt reliance. Still, improving earnings and interest coverage is crucial. So that's all from me. Thank you.
Now, let's move on to profitability ratio. Profitability ratio measures how well a company can generate profit from its sale, asset, or equity. This ratio provides insight into how efficiently a business operates and how well it turns resources into profit. The key profitability ratio include gross profit margin, operating profit margin, return on asset, and return on equity. First, we look at the gross profit margin. This ratio indicates how much profit a company makes after deduct the cost of goods sold. The highest margin was recorded in 2023 at 0.45%, while the lowest margin occurred 2021 at 0.47%. Next, we have the operating profit margin. This measures how much profit remained after covering operating expenses. The stronger performance was in 2019 at 0.22, while the weakest performance was in 2020 at 0.18. Moving on to the profit margin, which reflects to overall profitability after all expenses include tax and interest. The highest margin was achieved in 2019 at 0.114, while the lowest was in 2022 at 0.12. Now let's discuss about the return on asset. It shows how effectively a company uses assets to generate profit. The highest was recorded in 2019 at 0.17, while the lowest was in 2022 at 0.14. And the last one is return on equity. It measures how effectively the company generates profit from shareholder equity. The stronger was in 2019 at 0.93, while the weakest was in 2023 at 0.32%. In conclusion, profitability ratio provides a clear picture of a company's ability to generate profit and create value for its shareholder. By examining trade over the year, we can see where the company has performed strongly and where challenges have impacted its profitability.